Good morning. I'd like to invite our panelists to please join me up here on the stage, starting with Matthew Watkins, who we are honored to have here today from the World Business Council for Sustainable Development. Please help me in welcoming him. Perhaps we'll begin with him and let the other panelists stay in the audience for now. But I would just like to acknowledge Matthew's amazing work with the World Business Council for Sustainable Development on measurement and valuation of non-financial capital, which recognizes that business depends on not just financial resources and not just human capital or intellectual capital, but also natural capital and social and relationship capital. He has 10 years of experience working in the fields of business and sustainability in both NGO and the private sector. And he holds also, fascinatingly, a Bachelor of Medicine and Bachelor of Surgery and a master's degree in the environmental sciences. So a real multidisciplinary leader, and we're eager to hear what you have to say. Thank you.
Okay, thank you very much. So I work for an organization called WBCSD, which is the World Business Council for Sustainable Development. So as WBCSD, then we are a membership organization. We work with 200 multinational businesses, and we work on various different sustainability topics. We work on traditional sustainability topics like energy and climate, like citizen mobility. But the program that I work on is a little bit different. It's called Redefining Value, and it has a three-part theory of change in our work on redefining value. So what we really do is we help businesses to make better decisions based on a more holistic picture of value. And this critically includes the value of people, it includes the value of nature. We then help the businesses that we work with disclose this information to external stakeholders, and particularly to financial markets, with the idea that financial markets will then make their decisions based on this information and channel flows of capital to the least risky and more sustainable companies, all of which we see triggering more companies to be sustainable. So this is a little bit about what we do as WBCSD. We have a little joke with our main contacts who are generally in a CSR role or in a sustainability role. And we tell them that eventually we would like to make them all redundant. And the reason we say that is actually because we have a main theme about integrating sustainability within normal business functions. We'd really like to see the topics of sustainability, the value of people, the value of nature embedded in normal business decisions rather than as a standalone optional extra for companies. So that's a little bit about WBCSD. I'm in fact not actually going to be talking about WBCSD this morning. I'm going to be talking a little bit about how companies manage risk. I'm going to be talking about how companies understand value, and I'm talking a little bit about how companies report this information externally. So the first image that I'd like to talk about today, this is a summary of the World Economic Forum Global Risk Reports for the past 10 years. So what we can see here are the top 5 risks by likelihood and the top 5 risks by impact. And if we take a journey back in time, 10 years, then what we see are a lot of these blue risks. We can see asset price collapse. We can see oil and gas price spike. So these blue risks are all economic risks. So this is what the world was thinking about 10 years ago in terms of major global risks. But if we move through time until we get to today, 2019, then what we see happening are there are a lot more sociological risks cropping up. There are a lot more of these green environmental risks cropping up. And we also have geopolitical and technological on there, which we could also think about in terms of social risks as well. So what we see is really significant change in the risk landscape over the past 10 years as we move into 2019. But the question that I'm going to be asking today is, has companies' understanding of these risks relating to people and the environment, has this really changed significantly? And do companies consider these risks in their risk management and in their decisions that they make on a day-to-day basis? And I think you can probably gather from the title of the presentation that the answer is no. Companies are not dealing with this change particularly well. So this is a piece of research that we did as WBCSD. And what we looked at is we took all of our member companies' sustainability reports, and we looked at what were the material issues these companies were talking about in their sustainability reports. We also took the same companies, and we looked at their financial filings, and we looked at what material risks these companies were disclosing in their financial filings. And what we found was that out of the main sustainability issues, these material sustainability issues, then there was only a 29% alignment between what companies were saying were material in their sustainability reports and what they were talking about in their financial filings and what they were properly managing in their enterprise risk management systems. So we can see there's really a long way to go in terms of improving alignment and better integration of ESG risks into company management. And I'd just like to mention a little bit more about what some of these risks potentially are. So the TCFD, the Task Force for Climate-Related Financial Disclosure, has been quite a big thing for business over the past few years. And it tells us we need to think about physical risks, and it tells us we need to think about transition risks. So in terms of physical risk, and we can see a climate-related risk in the top right-hand corner here. But we can also think about the TCFD framework and how this applies to other risks beyond climate as well. So one example of this, we could think about the Gilets jaunes protests in France, which have caused considerable operational disruptions to businesses operating in the country as a result of not a climate-related issue, but a social issue. And here we're talking primarily about inequality. Other risks that we're thinking about here, we're thinking about business reputation risks and customers not buying products because of significant negative impacts of businesses on the environment and on people. Other risks include legal risks. Most notably, over the past few years, we've seen significant legal risk in terms of companies with significant negative impacts, including Volkswagen, including BP, and I could name a lot more as well. In terms of risk of disruption, here we're talking about risks related to technology. So these are the types of risks that companies really should be better understanding and better managing in relation to their impacts and dependencies on people and on the environment. So just to give you a couple of specific examples, here we have an example of Vale, the Brazilian mining company, who recently had the catastrophic mining dam collapses over the past few years in Brazil. And an example of an environmental risk. Here we can see that actually 3 of our member companies as WBCSD were affected by this. This is Solvay, Shell, and BASF. And they were all affected by low water levels in the River Rhine caused by record high summer temperatures. And what this shows is that these companies are not significantly recognizing their impacts, and, well, in this case, their dependencies on ecosystem services, and particularly on climate services. And this had a major impact on the bottom line of all of these 3 companies that were affected. So, one question to ask now is, why are companies not able to respond to these environmental and these people-related risks? And one reason I would say is that companies don't have a full understanding of their value. They don't have a holistic understanding of their value. So what companies do know about is their tangible capital, which we can see on this graph here on the right-hand side. So this is a graph from the Embankment Project for Inclusive Capitalism. And what this project did is they looked at the tangible value of companies, which is the value that companies have on their books. So this is really talking about the premises of companies, the equipment that they have, the amount of money that they have in their bank account. And what we can see is there's a huge difference between this tangible capital, the tangible value of a company, and the line we can see at the top of the graph in the middle, which is the total market value of the company. So this is what shareholders value the company at. So the next logical question is, really, what is this extra value? What is this gap? And it was the conclusion of the Embankment Project that this gap is made out of the value of people, and it's made out of the value of nature. So here we can see a couple of examples. So here we're talking about human capital, the value of an engaged, skilled, and healthy workforce. We're talking about the value of nature, the value of the environment, the value of ideas. We're also talking about the value of brand, the value that a company has in terms of its of how it's trusted by people that buy its products. So what we see is that companies are really making decisions based solely on their financial value, whereas this can be only around 20% of the total market value of a company. So there's a really big gap for companies to better understand value, and in particular the value of people and the value of nature. And I'm just going to read a very short quote by Bill Gates that talks a little bit about this topic. And this is that the idea that today anyone would need to be pitched on why software is a legitimate investment seems unimaginable. But a lot has changed since the 1980s. It's time the way that we think about the economy does too. And this quote is specifically around intellectual capital, but I think we can apply the same principles to the value of people and the value of nature as well. And I have a couple of results from some surveys to talk about as well. Again, reinforcing the gap that we have in terms of the data the businesses has to make decisions with. So this is a survey from an organization called AICPA-CIMA. It's the Chartered Institute of Management Accountants. And they found that 80% of organizations used flawed data to make a strategic decision over the past 3 years. They also showed that 32% of respondents felt that information, both financial and also non-financial, that was delivered to decision makers, only 32% was relevant and timely. They also found that 34% of respondents found it challenging to select the right metrics, and only 40% showed sufficient understanding of how business models need to adapt to market needs. And we can see the same thing if we go up to the CEO level. So this is a survey from our colleagues over at PwC. It's part of the PwC CEO survey. And if we focus on the results from 2019, which are these gold bars, then what we can see in the top line, we can see how many CEOs said these issues were critically important. And on the bottom line, we can see how many CEOs said they had enough information to make decisions around these issues. So what this really shows is this gray area in the middle of these lines is really the gap that we have around extra information that's required for company decision making. And it's a hypothesis as WBCSD that we can do a lot to fill this gap by including the value of people and the value of nature. So this is around issues such as data around brand and reputation. On the right-hand side here, we have data on climate change, and we also have data around employees' views and needs. So these are all areas that we have significant gaps in our current decision-making. So as WBCSD, we've had to think about what different areas within businesses can be enhanced by this extra data. And we've pinpointed 5 different areas around planning, around strategy, around budgets and costing, skills and competences, and around culture. And we've done quite significant work around risks and around enterprise risk management. And we're doing quite a bit of work at the moment around budgeting and costing, and particularly around influencing management accounting decisions. So we've talked a little bit about the value of people. We've talked a little bit about the value of nature. So what do we actually mean by this? So this is a slide that's taken from some work that WBCSD have contributed to in the Natural Capital Protocol and also the Social and Human Capital Protocol. So here, when we talk about the value of people, when we talk about the value of nature, what we're talking about for nature, we're talking about flora, fauna, and mineral wealth. When we're talking about human capital, the value of people, here we're talking about knowledge, skills, and competences, that contribute towards well-being. And in terms of social capital, we're talking about networks, shared norms, and understanding that facilitate cooperation between and among groups. So in terms of the components of well-being, this is a diagram that I borrowed from OECD. I just wanted to talk a little bit about some of the potential components of well-being that OECD recognize. So here, when we're talking about human capital, we're talking about education, skills, we're talking about health status, we're talking about housing, jobs, earning, income. So this is a little bit of a flavor of what we're talking about by human capital. So as I mentioned, the last slide was taken from these two protocols that we've helped develop as WBCSD. We have the Natural Capital Protocol, we have the Social and Human Capital Protocol, which came out earlier this year, both of which provide generally accepted frameworks for businesses to measure and to value both their impacts and also their dependencies on people, society, and the environment. And I'm just going to talk a little bit about some of the reasons why business might want to do this. This is a diagram for the Social and Human Capital Protocol, talking specifically about some of the reasons why business might want to value their impacts and dependencies on people. So we put these on a spectrum through from minimizing risks through to capturing opportunities. On the risk minimization side, we have obtaining or maintaining a license to operate, followed by improving the business enabling environment. And we have some good examples of Siemens as one example, which is a company that have valued the presence of Siemens operations in different countries around the world, and have used this to position the company as a supplier of choice with national governments. We see companies that are applying these principles in order to optimize human management, human resource management. And again, Nestle would be one example to mention here. So one activity that Nestle did is they looked at all of their youth employment services, including agricultural entrepreneurship programs, including a whole range of different youth employment activities. And what they did is they valued the impact of these on Nestle, the value to the business, and they also looked at the value to society of these different programs, and have started to make decisions in order to channel flows of capital to the programs that are most successful, both for the business and both for society as well. We see businesses that are applying this approach in order to strengthen value chains and also to encourage product and service growth and innovation. And Solvay would be an example of one company that we've worked with that has looked at the impacts of different products within its product portfolio and looked at the negative and positive impacts of said products and uses this information in order to screen out negative products and innovate towards a more sustainable product portfolio. So these are a couple of examples that I wanted to mention of where businesses have used this type of information to the benefit of both the business and to wider society. So I won't spend very long on this because we don't have very long this morning. If you'd like to find out more about the protocols and around our work on enterprise risk management, then I do have a session just after lunch. I think it's workshop 4. If you'd like to come along, we'll have more of an opportunity to talk about these then. So on this slide, all I wanted to mention really is that we have the Natural Capital Protocol and we have the Social and Human Capital Protocol, which are both sister documents. They have 4 stages. document and 9 steps within each document, which is a harmonized framework across both documents with the idea that they can be used hand in hand. In terms of being used hand in hand, this is something that we see as being particularly important. With the businesses that we work with, they often look at their impacts and dependencies in a holistic way on people and the environment together. And for us, this is something that's really important to understand. And I'll give you one quick example of why this is. So one of the businesses we work with is a German automobile manufacturer. And they were telling me that if they were to consider a decision as to whether to make more electric vehicles, then if they were just to consider their direct impacts on people, then this would actually look like a bad decision because these vehicles take less time to manufacture, require the employment of less people, has less money flowing out into local communities, and it's really only once you consider both the natural and also the social and human capital impacts together over the life cycle of the vehicle, including in particular climate change impacts, that you're really able to make the correct decision as a result. So a big part of the protocols is helping business decision making. So it's chapter 4 in the protocols is really integrating this information into business decision making. But we also see a lot of businesses that would like to communicate this information externally as well. And this is just one example of the type of information that we see quite a lot of businesses communicating at the moment. So this is an example of an IP&L, an integrated profit and loss statement, where you can see that a lot of businesses have done something similar in terms of looking at their retained benefit to shareholders, looking at the value of their economic impacts, their broader economic impacts, their social impacts, and their environmental impacts. And we see a lot of businesses that have done similar to this, some of which add these up into a total net figure at the end. So we see this as an interesting trend. It certainly has a lot of challenges associated with putting together something like this that we still need to overcome, particularly around whether it's possible to add up impacts on people and on the environment, whether we're talking about the same thing. We need to think about the fact that really everything depends on natural capital. You may have seen Johan Rockström's SDG wedding cake. In this diagram that he put together, he took the 17 SDGs and he put the environmental SDGs on the bottom layer, followed by the social SDGs, and followed by the economic SDGs on the top layer, with the idea that everything depends on natural capital, flowing into social capital, flowing into economic capital. So these are the kinds of issues we need to think about in terms of trade-offs when we're talking about putting together a statement like this. We also need to think about issues around what investors or the financial community might do with this. We're not currently at a stage where this information is necessarily reliable and certainly not comparable between different businesses. So these are definitely some of the limitations that we see around this type of external communication approach as we are today. But we do definitely see an appetite for this from businesses and an appetite for communicating this information, particularly to their external stakeholders and particularly to financial markets. So this really reflects a trend that we've seen over the past few years in terms of significant investor interest in ESG investments. As we've heard throughout the past couple of days, we've seen significant increases in the amount of ESG investment. From our experience at WBCSD, we also see a rise in SDG bonds and in green bonds. One of our companies, PepsiCo, just launched a $1 billion US green bond just last month. We're starting to see the rise of ESG-linked loans, which are loans that have an interest rate that is linked to company sustainability performance. We're also seeing examples of our members working with blended finance. We work with a number of banks, including BNP Paribas, which have big projects in this area. So just before I conclude, I'd just like to leave you with this cartoon that I thought was quite funny, which reminds me of our current over-reliance on financial capital to the detriment of thinking about the value of nature and the value of people as well. Because as somebody reminded me, as our CEO at WBCSD likes to say, businesses can't succeed in a world that fails. So just to finish off by summarizing a couple of key points. Firstly, we can see that business management systems are not yet responding to trends in terms of risks relating to people and society and the environment. We can see that it is critical to understand components of value today, going beyond financial value and talking more and thinking more about the value of people and the value of nature. We can see that there are multiple functions of business which this information can be integrated within, including management accounting, including risk management, but also other areas of business as well. We can see that business disclosures on ESG issues, we've only touched on this a little bit today, are currently of limited efficacy, and we need to think about how to improve this. And lastly, we can see that financial markets, in our theory of change, offer a significant lever to help us move towards more sustainable companies and a more sustainable world. And I will just add one extra point, again, in relation to our theme of going mainstream. We see a lot of sustainability products, we see a lot of sustainability frameworks, and these frameworks and these organizations working on them have done a fantastic job. They've helped us to create real progress. But where we really see an opportunity to go mainstream and really scale this work is by integrating into current business functions and processes. So that's really all I wanted to talk about today. Thanks very much for your attention. So thank you.